Hi, everyone, and welcome to another edition of the MAI Market Update. I'm John Zoller, CIO of MAI Capital, here to host a conversation with Nick Cermak, Senior Portfolio Manager at MAI and the Chair of MAI's Fixed Income Committee. Well, what started out as a decent comeback for bonds in 2023 has now largely fizzled out following the most recent move higher in longer-term interest rates. While we continue to believe bonds play an important role in portfolios requiring stability and income generation, it's been a frustrating 18 months in terms of returns. So Nick, first of all, thanks so much for joining me today, and just curious your perspective on why bond yields are continuing to rise.
Hi, John. Thanks for having me on. It's an interesting question given that inflation is now off the peaks and is certainly in a slowing trend of late. Clearly, the increase in the U.S. federal funds rate from effectively zero back in early 2022 to above 5% now has driven the 10-year Treasury yield to its highest level since 2007, and that's led to difficult returns in the bond market. That's not the only factor exerting upward pressure on bond yields at the moment. The resiliency in the labor market and this notion that the U.S. economy could experience a soft landing have pushed growth expectations higher of late. And as a result, real yields, which are a proxy for growth expectations and one component of Treasury yields, have risen in recent quarters. Now, another component of yields is the term premium, and that's the added compensation investors require to lend over longer time periods or for taking more credit risk. An easier way to think about the term premium is it's really simply any factor not related to growth or inflation expectations that impact the required yield for bond investors. Now, the fiscal situation in the U.S. has been in focus of late, particularly after Fitch downgraded the credit rating of the U.S. by one notch over the summer. And certainly the fiscal picture has deteriorated as interest costs and deficits have risen, but at the same time, we've also seen significant U.S. Treasury issuance as the Treasury has looked to really refill its general account after the debt ceiling deal in July. That added supply in the market, paired with a worsening fiscal situation, has pushed that term premium and thus bond yields higher of late. And also, don't forget, rates aren't just rising in the US. Other major central banks are combating inflation as well and increasing rates. We're even seeing the Bank of Japan looking at easing its yield curve controls and potentially ending its negative interest rate policy as early as next year. So this hawkishness from central banks has extended globally and is acting as a rising tide for bond yields across the globe. So as you can see, there are a number of reasons yields have continued to move higher in this market, even at a time when inflation has been slowing.
Well, definitely a lot of factors to consider there, Nick. What's your perspective on the Fed funds rate? Have we reached the peak now?
I think it depends on who you ask. So at the September FOMC meeting, Chair Powell indicated that additional hikes might be necessary. And the most recent dot plot also shows the expectation for one more 25 basis point hike by the end of this year, and then rate cuts beginning in 2024. Now the market, on the other hand, is a little more skeptical. It's only pricing in about a 50% chance of a 25 basis point increase this year, and then a shallower path of rate cuts than what the dots imply, which is also consistent with this soft landing narrative that's being talked about in the market. I think the answer to the peak rate question, though, really depends on the idea of whether or not the neutral rate of interest has moved structurally higher. John, you spoke about this in last month's update, but that neutral rate is the level of interest rates that is considered neither restrictive nor accommodative in terms of economic output. There's been some speculation that the neutral rate may have moved higher in recent years, which, if that's true, could mean that policy might not be as restrictive as policymakers think. If that's the case, then rates may need to remain elevated for longer than investors currently expect, or even potentially move higher than what's being priced in at the moment. While it's difficult to observe the neutral rate in real time, one proxy that we watch is the 5-year Treasury forward, and that measure has clearly trended higher since 2020. It's currently nearing 4.5%, and that's a full 2% higher than the FOMC's median longer run estimate of the Fed funds rate. So that's something we're definitely keeping our eyes on. But to answer your question, I think we are getting close to the peak in rates, but there are some reasons to believe rates could remain elevated for potentially longer than what is currently expected by investors.
So, Nick, with all of that context in mind, what have we been doing from a positioning perspective within client portfolios as a result of higher rates?
Sure. So the simple answer here is that we've gotten more defensive within fixed income as an asset class. As a firm, we believe that the net effect of rate increases has yet to fully make its way through the economy. And despite talk of a soft landing, recession risk should remain elevated over the next 12 to 18 months. So there's two primary ways we've looked to mitigate risk in our bond portfolios. The first is that we've been incrementally adding to our duration exposure as rates have risen. And while it's difficult to definitively say when the last rate increase for this cycle will occur, history has shown that bond yields tend to peak around the time of that final hike. And having more duration exposure should benefit bondholders in the event of an economic slowdown. And indeed, Chair Powell has guided that a period of below-trend economic growth will be required to bring inflation down to their 2% target. Now, the second way we've gotten more defensive is to scale back the credit risk in our portfolios by moving up in quality, essentially favoring investment-grade credit over higher-yielding sectors. And the one interesting piece about this rate cycle is that credit has continued to perform well despite both monetary policy and financial conditions tightening significantly, as well as credit fundamentals starting to deteriorate. So with credit spreads still sitting below historical averages, we've reduced positions in higher yielding sectors like emerging market debt and floating rate bank loans in favor of higher quality investment grade corporates, municipals, and treasuries, which should be more resilient in a worsening or more difficult economic environment. Generally, MAI takes a very conservative and measured stance towards fixed income investing, focusing on stability and capital preservation, and these moves are consistent with that mindset as we continue to navigate this rate cycle.
Well, Nick, thanks again for joining me to talk through all the variables impacting interest rates and bond portfolios. Obviously, bonds are often just one component of a well-diversified portfolio, but it's important that they play the role of a stabilizer if we do face a tougher economic climate ahead. I think your comments around how we're repositioning today lends itself to that goal. To our clients, thank you as always for listening in and for the trust and confidence you've placed in us to navigate this ever-changing market environment with patience and perspective. If you have any questions related to this topic or specific to your portfolio, please don't hesitate to reach out to your wealth advisor at any time. Take care, and we'll see you next time.